I'm Brian Estes. I'm the CIO and managing partner of Off the Chain Capital. I'd like to introduce Tim to you. He'll give you his background. We're going to introduce Perianne, and then Perianne will get started with her section. And basically what we're going to talk about today is Bitcoin and why you should, it's the, so we're going to talk about Bitcoin and why you should add it to your portfolio as an asset class. Plus go over the history of money in Bretton Woods and hopefully give you a good solid background of the monetary system and why Bitcoin's so important today. So Tim, you want to introduce yourself?
So my background is traditional asset management. I started at NCR, worked at IBM. So I entered managing money with a really good technology background and allowed me to have some really good performance because I was able to see a lot of technology changes as they occurred. I spent a decade at Federated Investors in Pittsburgh, and then I was the chief equity officer at John Hancock up in Boston. I ran a few value funds. So I ran 3 5-star funds, a global value, a small cap value, and a large cap value fund. I finished my career at BlackRock as a managing director running an absolute value fund. And I often go back to folks that I used to work with, and I refer to Bitcoin as, no, guys, really, this is the best idea I've ever had. This is just unbelievable. So I'm looking forward to sharing with you guys today some insights that have kind of dawned on me as I studied Bitcoin. Perianne?
Yeah, thanks so much. My name's Perianne Boring, and I'm the founder and president of the Chamber of Digital Commerce. So my background is in public policy. I live and work in Washington, D.C. I grew up in Lakeland, Florida, so I'm a native Floridian. And I moved to D.C. to work on Capitol Hill. So I worked for a member of Congress from Florida, and my focus is in economic policy. So my interest in digital assets and cryptocurrencies is an alternative to the central economic planning that we're all familiar with today. And having other alternatives out there like Bitcoin was a topic that was very fascinating to me as somebody working on macroeconomic policy in Washington. So I became incredibly interested in this technology. And then 6 years ago, I just decided this was the most important thing I will ever see in my lifetime. And so I left my work in government and started the Chamber of Digital Commerce. We're a nonprofit, and we are working on different policy issues that impact blockchains and digital assets. I'm also an adjunct professor at Georgetown University Center for Financial Markets and Policy, and I'm a fellow there as well. And then I've recently joined the team as an investor at Off the Chain just this year. All right, we'll get started. Okay, so we're going to go through kind of the history of money and then kind of dig into our analysis on Bitcoin as an investment class. What I think is incredibly important to for you to really understand why Bitcoin and blockchain related assets are one of the most important investment opportunities you can look at today is you really have to understand how this technology fits into the global economic landscape. And this is an issue and something I've been following for most of my career, but right now, given where we are with the pandemic and how that's impacted the global economy, what this means and the value this brings to the market is more clear today than I think really ever in history. So just starting with a quote from Hu Jintao, who's the former president of the People's Republic of China. He says, the current international currency system is a product of the past. So where we are today, there's history behind that. And it's important to understand what that history is so you can understand what Bitcoin represents in today's environment. Money, if we track the history of money all the way back to the beginning of economics and civilizations, it was Aristotle, the famous Greek philosopher, who first defined money. And he created these 4 characteristics and 322 to 384 BC. So we've known what money is for a very long time. It's, money and currency is the lifeblood of an economy. It's what we use to exchange our goods and services. And it's incredibly important that the currency system works in order for an economy to operate, in order for communities to be able to operate, in order for us to be able to function in our daily lives. And to me, that's something I've always been passionate about, is the health of the currency, of the money. So money for thousands and thousands of years has met these characteristics, being durable. So if you think about, before we had, computers and lived in a digital world, had to be something that could stand the test of time. And back then, gold and silver and precious metals is what most civilizations were using. So you think of gold, it can be outside, it can go through different weathered environments. It needs to be portable. You need to be able to take it around with you. Divisible, you've got to be able to cut it up into smaller parts. It needs to have intrinsic value, meaning it has value within itself. Juxtaposing that to what Bitcoin is, there's many people who have compared Bitcoin to a digital form of gold. Even our current chairman of the Federal Reserve, Jay Powell, testified in front of the House Financial Services Committee last year, saying he believes Bitcoin is like digital gold, really confirming its use as a store of value. But Bitcoin, because it is a digital asset, it has more properties than what a physical asset can ever have. So it's durable. It lives online. It lives in a digital format, and it can live for infinite generations going into the future. Portable. You can have lots of cryptocurrencies on your device, and you can take that with you in a very simple way. It's more divisible than anything physical, because you can divide it into units that are even smaller than a penny. So one of the interesting things about Bitcoin is it enables micropayments. So today, if you want to send 1/10 of a cent, there's not really a way to do that. With cryptocurrencies, you can, because you just move the decimal point one more step out, enabling transactions at even a smaller and a more micro level. They're also immutable. Well, at least Bitcoin is. Meaning once a transaction has been confirmed, you can't go back and erase it or change history. Cryptocurrencies are also programmable, so we can now program money to do things for us, which is a very interesting concept in monetary policy. You think about how interest rates are set today by the Federal Reserve. You have a group of people who sit around a table and make these decisions, and they're supposed to be completely independent of the political process, so they're an independent group. But if you have someone who influential, like the President of the United States, tweeting at them, encouraging them to do what he wants them to do, that could impact the psychology of what's happening. So the independence of that board can be impacted in a way because it's humans. With programmable money, and this is what China has done. So China has built their own cryptocurrency. And things like interest rates can be set using algorithms in math, meaning when the economy does this, the interest rates are set at this, and there's no human intervention that can manipulate that to something else. So you can program the currency in a way that is way more accurate than human central planning could ever do. It can also be verified because you have a public ledger. And then in terms of storing it, you can store very, very large amounts of cryptocurrency in an easy way, very different than gold, where if you have significant holdings in it, you have storage considerations you have to take into account. Bitcoin has many properties above and beyond what fiat money can offer, and even more than what gold and silver and other precious metals have offered. And just to kind of walk us through the history of money, up until really the 1970s, we have used things of scarcity as money. So things that have a fixed supply or a limited supply. So shells were at the very beginning of civilization, moving to precious metals like gold, and then going to gold coins, and then banknotes and credit cards, and now where we are with Bitcoin. Under the note section, first, these were notes that would have been backed by a precious metal, or there is an underlying value of something scarce that's tracking to that. That has been changed just in recent history, and then now with digital payments and Bitcoin being the next iteration of innovation for money. So where we are today with what money is now is very different than what money was even just 50, 60 years ago. Again, for most of human history, people have used things that are scarce as money. Today we use what's called fiat money, and every industrialized nation today is using what's called fiat money, which is just essentially a government IOU. So if you pick up a dollar bill today, it does not say this is backed by gold like it used to. It says this is backed by the full faith and credit of the United States government. What does that mean? It's an IOU. But people trust it because you trust the US government as an institution. But think of a place like Zimbabwe or Argentina or other nations that have experienced very high level of inflation. That backed by the government means a lot less than backed by others, or something that's not pegged to something that's scarce. So we've used, we went from shells and stones and salt and wampum to gold, to notes. And again, those notes would have been backed or pegged to gold. And then moving to banks, bonds, and credit. And then just within 49 years, we went to fiat. So you may be asking, how did we get to fiat? Like, what did that transition look like? So this is a transition that's happened just within 75 to 76 years ago. After World War II, all the Allied nations had a meeting called the Bretton Woods system. They met in Bretton Woods, New Hampshire, and they got together and they decide what would be the monetary arrangement for the post-war era. And what the world agreed on at that meeting is that the price of gold would be fixed at $35 an ounce. The US dollar would be the world reserve currency, and there was a big fight about that. The US ultimately won, but what was proposed, and the other thing that was on the table, what was called the bank war. And this would have been a basket of international currencies together, not just the US dollar, but the US really pushed for that to just be the United States. And then all other countries would peg their currencies to the US dollar, and they could legally demand gold from the US Treasury. So that's what the world agreed to 76 years ago. And where we are today is so different than that. And a lot of people don't know that or haven't had the opportunity to appreciate that, but this is a huge difference. And it's been a very huge systemic change to the monetary system. And that's all happened within our lifetime, our parents' lifetimes, and maybe our grandparents. So this is a very, very new phenomenon. And this is not how things were supposed to be or what anybody agreed to of where we are today. It turns out keeping that $35 an ounce peg was really hard to do for the US, because immediately what the United States started doing was doing all sorts of spending to rebuild after the war. And we were spending way more than what we were producing. And that trend has continued up to modern day history. But within a couple of years, they could not maintain that $35 peg, because we had lots of countries demanding gold from the Treasury, and our gold deposits were being completely depleted. So it was just within a couple decades that, and Bretton Woods was in 1944. So by 1965 is when that transition to fiat started. By and they kept changing the price of $35 an ounce to $45 an ounce, and eventually it completely broke down. And in 1971, President Nixon, if you guys remember, like the Nixon shock, that's when he said, no more are we going to allow countries to redeem their US dollars for gold. And he closed the gold window. And by 1976, they changed the laws so that gold was not written in what the statute said of what money is. And then it wasn't until the 1980s that all industrialized nations moved to fiat, meaning not backed by a precious metal like gold. So where we are today with money, and it really was not that long ago that we were on a gold standard and that the whole world was on a gold standard. So a huge transformation has taken place. So then the next question you should ask yourselves is, how have we done? How has that benefited us? How has the economy performed after this massive shift in the way that money is issued and regulated and circulated? So I have a few different kind of ways that I'm looking at this, and different economists will kind of measure the strength of an economy. This graph here, we call it the everything bubble, and it tracks US household net worth. So how much a household, an individual household, what their net worth is versus GDP. And we take this all the way back to the 1950s, but that trend of those two things being in sync with each other, it would probably go back being in sync further if the data went back further than 1950. So until 1954, until the 90s, those two things were completely connected with one another. What happened is we had this dot-com bubble, and the disconnect between how much we're producing versus what our net worth is started to change during that time. When the dot-com bubble bursted, the Federal Reserve intervened to save the economy, and they lowered interest rates. And that's where you see that downturn in like 2002, 2004. And that created the next bubble, which was the housing bubble. And I'm sure we all remember the financial crisis of 2007 and 2008 that really impacted Florida in a huge way, because so much of Florida's economy is the real estate markets. So after the 2008 financial crisis, the Fed intervened again and lowered interest rates, and also engaged in quantitative easing and other methods to try to save the economy. And that's brought us to where we are today with what we're calling the everything bubble, which is really a bubble in most asset classes in most areas of the economy. And that discrepancy between net worth and what we're producing, our GDP, is getting wider and wider and wider. And so the space between those two lines is essentially, it's propped up, and it's you know, I don't want to say fake numbers, but it's not correlated properly, which means we're due for a correction. And you're starting to actually see that at the very end, where both of these are starting to tick down. So just the logic between how much we're producing, our GDP, and what we actually have within net worth, those should be together. But because of the central economic planning out of the Fed, those two things have split in recent history. And the Fed has had to continue to intervene to keep them propped up. But this can't go on forever. Another kind of way we can measure the economy is, and the health of it is debt. And this is global debt. And today, well, I guess in 2019, it would even be more today because of all of the stimulus that's happened as a result of the pandemic. These numbers are likely way more enhanced. But at the end of last year, in 2019, we had, the bars are focused on the global debt. So over $255 trillion of debt globally, which is 322% of GDP, which is a really unbelievable and astronomical number, meaning that we are spending 322% of what we are producing. Governments can get away with this because it's the government, but businesses can't get away with this. Households can't get away with this. So we are in a global economic debt crisis. And how we get out of this is definitely a huge question to me, because you can't really grow yourself out of 322% of overspending. As a business owner, when you hit a cash crunch, you either have to cut expenses or bring in more revenue. You can't grow yourself out of this is the issue. Also, looking at inflation, so the Fed's target inflation rate is 2%. And it's really amazing to kind of see where the world is in terms of inflation rates. And remember, inflation is a hidden tax. So every time the government prints more money and expands the monetary base, purchasing power decreases. So it is a hidden tax on anyone who holds the currency that's being inflated. Over 33% of all fiat currencies today have inflation rates of over 5%. Again, the Fed's target is 2. I would argue it should be 0, but I'm not the chairman of the Fed, so that's not my job to call that. But if I was in charge, that's where I'd put it. And then just within the G20, the average inflation rate is 8.6%. And 50% of the G20 has inflation rates over the Fed's target of 2%. So from an inflation perspective, inflation is on the rise. It's on the rise in small countries. It's on the rise in G20 nations. And again, with the pandemic, where there's been many governments who have had to come forward and print more money to pay for all of these programs to try to lessen the effects and the issues with coronavirus, these numbers are going to be heightened the next time we measure them. And then also financial inclusion is also continues to be a challenge, and not just in less developed nations, also in the most developed nations in the world. And right here in the United States, the Fed reported in 2018 that 22% of US households are underbanked. And what's really interesting about this number is that Congress has taken a much closer look at the financial inclusion problems that we have in the US. With the stimulus bills that Congress passed in the second quarter of this year, the response to that was the PPP loans and also all the money to individuals. And their goal was to get that stimulus money in the hands of Americans as fast as absolutely possible. And the way in which those funds were being distributed was through the banking system. But the problem is 22% of people in the United States are either don't have access to bank accounts at all, or they have limited access to the financial system. So what's happened with coronavirus has made Congress revisit the problems with our banking system. And there's been 3 hearings on Capitol Hill since March, 1 in Senate banking and 2 in House Financial Services, looking at modernizing the payment system. And in all 3 of those hearings, blockchain technology was the core topic they were debating. And we helped organize and set up a lot of the witnesses for all of those hearings. But the government is taking an incredibly close look at this technology today and how can it be applied to modernize and address the challenges within our financial system, financial inclusion really being the piece that spurred those conversations. And then if you look globally, there's 1.7 billion adults who remain unbanked today. But 2/3 of those people have mobile phones. So they do have access to advanced technologies, but not necessarily banking services. So there's other ways to reach these people. There's potential opportunities to reach these people with what we would argue with digital wallets, with Bitcoin and blockchain technology. But the banking system is also being radically transformed and changed today because of what this technology means. And then this is just a map that kind of shows where the unbanked populations is. And this is from the IFC, which is a division within sorry, I didn't put these notes in here. Just a site map kind of measuring where un- and underbanked populations are globally. In different ways that we're measuring the health of the economy, whether that's by looking at debt to GDP and or looking at inflation, looking at financial inclusion, on all of these measures, there are pretty dire consequences there to how our economy is actually performing today. And there's many people that recognize this, not just me. Some of the top most powerful people in financial services today. Christine Lagarde, when she was serving as the managing director of the IMF, she said virtual currencies might just give existing currencies and monetary policy a run for their money. So the people in the highest positions of power in finance and economics and monetary policy have publicly stated what Bitcoin and what blockchain technology means to the financial system. And then last year at Jackson Hole, and Jackson Hole is taking place this week. So we're at the 1-year anniversary of Mark Carney calling for a replacement to the US dollar. That was, I think, one of the most surprising things we have seen today because they're one of our biggest allies, and they know how important that the United States dollar is to the health of the United States, to our national security, to our economic security, and to have them call for something different really shows the systemic issues that we have in the US today. And there's a lot of global pressure for big changes to the monetary system. And those changes could be incredibly detrimental to the United States as a whole. And then of course, China is really I think the biggest antagonist here. China is actively trying to build a competitor to the US dollar, and they're in the finishing stages of rolling out their digital currency, which will be called the DCEP, digital currency electronic payment. There's very real threats to our future as Americans. If we have anything that threatens the US dollar as the world reserve currency, could mean very significant economic challenges to us. And so how do we address that? How do we fix these problems? Again, looking at that chart of debt to GDP ratio, you can't fix these current problems with the same tools that we have today. We have to think outside of the box. We have to throw the box away and create a whole new one. And that's what Bitcoin and blockchain technology really brings to the table. It is a paradigm shift in the way that we think of economics and monetary policy and financial systems. And that's why we believe that investing in blockchain-related assets like Bitcoin is the most important investment decision you can make today. Because it is something that is outside of this broken system that has proved to be a true alternative to the current system that's safer, more efficient, and more secure.
I always learn something new every time I look back at studying money, because you just don't get those courses in school. Like,
No, I didn't learn this.
yeah, it's
I
unbelievable.
went for the public school
Aristotle.
education.
I didn't know Aristotle gave us the first characteristics of money. That's really interesting. What I thought I would do is touch on Bitcoin as an innovation. Look, it's a really controversial topic. And what struck me was thinking about Bitcoin as kind of a piece of technology. It invented something. So think of it as a protocol layer. So we all know how the internet kind of developed with TCP/IP, and then TCP/IP wasn't really that great for sending emails. So we had SMTP as the protocol layer, which allowed email to transmit, very easily. And I like the SSL, the Secure Sockets Layer protocol, because that allowed e-commerce. So without that protocol layer, it would be very difficult for you to justify swiping a credit card over the internet, a really unfriendly place. So the SSL protocol layer was the layer that allowed this use of encryption technology that enables you to swipe credit cards. So think of Bitcoin as, and then think of all these protocol layers as the way to transmit information from person one to person two without a third party. So information from me to you without a third party. But what I couldn't do until Bitcoin was I couldn't communicate value to you. I could say thank you to you, but I couldn't send you any money across the internet without a third party being involved. And that is just unbelievable. The fact that we could do Zooms now because of the protocol layers that allow for Zoom, and yet the people on the Zoom, I wouldn't be able to transmit value without a third party as readily as I could kind of see them. So this was an unbelievable breakthrough. So I like to think of Bitcoin as, oh my God, it's a breakthrough protocol layer that was invented 11 years ago. So what was this protocol layer? What did Bitcoin actually do? There's something called the Byzantine General's Dilemma. And what is that? It's a computer science problem where they're trying to get a network of computers to agree on one thing without a third party. So we're trying to get, the internet is a bunch of network computers. We're trying to get that network of computers to agree on a fact without a third party getting involved, okay? It's called the Byzantine General's Dilemma because they compare it to a group of generals surrounding the city of Byzantine. And in order to successfully sack the city, they all had to agree at attacking the city at a particular time. Now it's wartime, so to get messages to all the generals and to make sure that the message is safe, because you're gonna have false messaging during wartime, you had to agree, all the generals had to agree to attack at one specific time or the city wouldn't be a successful attack. So that's why they call it the Byzantine General's Dilemma. And what Bitcoin did was it put together several technologies that enabled this network of computers to communicate without a third party and agree on a central fact. Let's go back to what Perianne talked about, money. The internet didn't have its own money. There was no way to communicate across the internet without a third party. What the internet needed all these years was its own money. And now that we had the ability to have the internet without a third party agree on one specific fact, we can apply that now, and we can apply it to money. So they applied it to a ledger. Money is simply a ledger. So how do you keep a ledger safely and securely? You have to decentralize it. So we take we're taking public and private key cryptography, SHA-256, and that's 2 to the 256 power. So we're using very strong, like impossible to hack encryption technology, and we're embedding and we're creating a ledger that we're going to pass on a peer-to-peer basis to different networks of computers. So we're taking encryption technology, we're combining it with BitTorrent, which is a file sharing arrangement to get your decentralization. We're combining that with blockchain, and blockchain is simply the ability to pass this ledger from one computer to the other and add to that ledger without altering prior commitments to the ledger. So there's no going back and changing what was already printed. So that's blockchain technology. And then setting up this protocol, we had to kind of bootstrap it. So in order to bootstrap a money, the monetary policy of this of this protocol was that we're going to have a fixed amount. So there's 21 million Bitcoin hard-coded in the software package, okay? So now you've got Bitcoin as a protocol, big B, and then we have 21 million small b Bitcoin, which are the tokens that you need to use this particular protocol. And so there's a couple of different segments in this. We have nodes, and I run my own node. And what that means is I just go on the internet, I download the open source software of downloading the Bitcoin open source software. So I carry with me a working copy of all of the Bitcoin transactions that have ever occurred. So I have a copy of the ledger, and it gets updated every 10 minutes. So that's a node, and there's 15,000 nodes across the world that just pass around this very accurate, audited every 10 minutes. Those are the node operators. Now, if I want to send a Bitcoin to you, I'm going to post a transaction to a block. And there's several transactions occurring every 10 minutes. So a lot of transactions go to a block. And then miners come in. I don't know if any of you know about miners. So miners come in and they take a look at the verified blocks, because all the nodes take a look to make sure that I have the Bitcoin. And they say, yeah, Tim has the Bitcoin. He didn't already spend it. And he now wants to send it to you guys. So what the miners will do now is they'll compete to post that block to the ledger. And so there's a group of miners, also open source software, that they spend millions of dollars on software and hardware in order to compete for this block. And they solve a problem, and the winner that solves the problem first gets to post the block to the ledger. So now there's a new transaction on the ledger, which includes my Bitcoin transaction. And so why does the Bitcoin miner do this? Why does he perform this? Because he wants to earn Bitcoin. He gets paid Bitcoin, and he gets paid a fee to post the block to the ledger and update the now newly audited ledger. So here we have a protocol that involves 15,000 participants, nodes, that keep a fresh copy of the Bitcoin blockchain. And then we have miners that continue to post and update the ledger with the new transactions. So what did all this do? It solved double spend. Prior to being able to do this, there was no way to tell whether I'm going to double spend my Bitcoin that I sent to you. So prior to this, there was no such thing as digital scarcity. So Bitcoin solved the double spend problem and also invented the word digital scarcity. So these are just unbelievable innovations. And so now the internet actually has its own money native to itself. So Perianne talked about this a little bit before. She said, wow, you could spend a micro transaction. I can send you a half a cent, but I wouldn't send you a half a cent because I'd need a third party. And the cost of involving the third party would make it like crazy for me to send you a half a cent. But now, because Bitcoin is a protocol that's native to the internet, we can communicate without a third party. And therefore, I can very efficiently send you a half a cent, and it's not a big deal. So this is internet money. It's, we don't know where this is going to go. This is unbelievable. Again, back to the internet, communicating to you without a third party. But I couldn't communicate value to you without a third party, so until now. And so we're just now beginning to see what this Bitcoin thing is going to open up in terms of other innovations.
Yeah, another way that I've heard people kind of talk about double spend and kind of breaking that down is if you take a picture on your phone today and you want to text it to your friend, you send them a copy of the picture so that you have a copy on your phone and then they have a copy on their phone. If you're sending money, so if you're trying to text $1 or $20 to your friend from splitting lunch, it's really important when you send it to them that they don't receive a copy, they actually receive that instrument. That they don't still have the $20 on your phone and then they have $20 on their phone. So that's what's called a bearer instrument, meaning who holds it, owns it. And Bitcoin was the first opportunity to introduce a digital bearer instrument.
Thanks. So Bitcoin is the money, it's the hardest money in the world. So another thing that you want to think about is when you study, Austrian economics is another study of economics that's not taught in school, but the study of economics is the study of human behavior. And if you look past throughout hundreds of thousands of years, humanity gravitates toward the hardest money, the scarcest thing that they tend to use toward money. So in Perianne's presentation, you saw the evolution of money, and as you evolved into a harder and harder money until recently. We're in this time period now, which is the experiment that is an unbacked money. And now you've got Bitcoin, and Bitcoin is really scarce. It's digital scarce, and it's going to be scarcer than gold soon. So the Austrian economics, according to human behavior, we believe that human nature will gravitate toward this harder money because it'll recognize the scarcity and create a lot of value. This is the market speaking, actually. Your north-south axis is price, and east-west is time frame. And the dark line is the price of Bitcoin. And so early on when Bitcoin was invented, I didn't really know in 2009. I learned about Bitcoin in 2013. And read the white paper. I wish I read the white paper. It's only, 6 pages or 8? 12. It's 12 pages. But it's a very easy read. So a lot of people didn't read the white paper until 2013. And guess what happened then? They realized what this was. This was a protocol. And so these are 2,500 other coins, other cryptocurrencies. Now, we're talking about Bitcoin today. What about all these other coins? And these are all other versions of, I can do the protocol better than you, Mr. Bitcoin. We see the market potential, now we want to do it. So think of all of these other coins as like a Litecoin. Hey, I can do it faster because Bitcoin's every 10 minutes. I could do it every 5 minutes. So maybe that's better. I could do it more privately. I could program more. That's Ethereum. So all of these other coins have attempted to do something different than this main protocol. And I would argue that the market is basically saying, hey, we've kind of ossified around a protocol, TCP/IP, SMTP. It's not going to change. It's Bitcoin. So I'm going to ask you today to do a couple things. One, read the white paper. Number two, focus on Bitcoin, because that's where most of the value is going to be created. So that's, and the market agrees with me, because this is the price of all of the other coins relative to Bitcoin. All right, so what makes Bitcoin unique? And when you leave here today and you hear about, another coin, and you're like, well, how do you know Bitcoin's going to be the winner? And I would just say to you, answer one question. Is there a third party? Bitcoin doesn't have a third party. Satoshi Nakamoto is no longer involved with Bitcoin. He left in what year? 2013. So because Bitcoin doesn't have a foundation, a marketing department, a country behind it, it just operates as a consensus. So it's sovereign unto itself. Bitcoin makes its own rules. You can't call Bitcoin in front of Congress and say, hey, we don't like what you're doing. We want to ban this. So as a result of that, Bitcoin is uncensored. Anybody could use it. Anybody could download a wallet. Anybody could send or receive Bitcoin and store it. That's unbelievable. It's undilutable, 21 million. So there's no economic policy now that's going to say, hey, we're going to make it 40 million. No, it's 21 million. So we've never had anything like this. This is unbelievable. This is a currency that is going to be so unbelievable scarce. So it's undilutable. And finally, because there's no third party, because Bitcoin has created so much economic value over the last decade, because of that, there's a ton of miners that are committing resources because they're trying to earn Bitcoin. And the more the miners commit toward mining and securing the Bitcoin blockchain, the safer Bitcoin actually becomes. So Bitcoin right now is considered immutable. To prove my point, if I wanted to send a transaction to Perianne and Trump, Putin, Xi decided that this was a dangerous transaction, that the one thing they wanted was for this transaction not to occur, they could do anything they wanted and they would not be able to prevent me from sending my Bitcoin transaction to someone else. There's no way of stopping it. So Bitcoin is powerful, it's immutable, and at this size, even nation states can't hack and break Bitcoin. I'm going to ask you to think about Bitcoin in a little different way now. COVID makes it a little easier, in my opinion, to think of the internet as a country, right? And this country, look, as a portfolio manager, as a global investor, if you gave me a country that was going to grow rapidly, I would just buy the currency of that country, and I would do really well. You know, I'd try to find a great company within that country, but just own the currency of the fastest growing country and you're going to do really well. Well, there's very little doubt that the internet is probably the fastest growing country in the world. I mean, even think of during COVID, how many more hours a day you're spending in this digital country. And now this country has its own currency and it's called Bitcoin. So then you're going to ask yourself, well, I don't want to just invest in this country unless I know the monetary policy. Because what if it has an inflationary monetary policy? I don't want to invest in the country that has an inflating monetary policy. And I just told you that the monetary policy of Bitcoin is there's only ever going to be 21 million Bitcoin. And currently there's 18.6 million Bitcoin that are out and in existence today. Said another way, there's not very many new Bitcoin that are going to be available to other investors as we go forward. So think of Bitcoin as a country, and right now that currency is valued as the 29th largest country. And so I could see a future where if we met next year, where this number is the 14th country or 13th. So I'm just trying to get you to think that there's some value to be created here, just if you look at Bitcoin as the currency of a country. Before I leave this, I want to touch on one other thing. This happens now. When there's problems in the overall world, there's a tendency, there's a muscle memory to say for global investors to gravitate toward the Swiss franc. Why? Because the Swiss franc was the last fiat currency to abandon the gold standard. So we have this one little country, post 71, up until 2000, the Swiss franc was 40% gold backed. So whenever there was problems elsewhere, it was Swiss franc, it's as good as gold. So again, think of this. Smart investors will, as they understand what I'm talking about here, will begin to view the internet money as they're viewing the Swiss franc. This is hard money. This is where I want to go to when I want to seek safety and refuge from what's happening outside of this particular currency. Jack Dorsey, CEO of both Twitter and Square. How many of you have a Twitter account? It's you know, I've been in the investment business my entire career, and I'll tell you, guys that I talk to that have $1 million research budgets put Twitter as one of their top 2 sources of information. So if you're not on Twitter, this is a great way to keep up to date on Bitcoin. You can follow Brian, Perianne, and myself. I'm Ledgerman on Twitter, and I just update. It's a great way to stay up on Bitcoin news. Jack Dorsey is the CEO of Square, and this is his comments on Bitcoin. Like, unbelievable. Like, imagine having, it's almost like a trade-free zone, right? You've got a currency that doesn't have to answer to all these other governments and what jurisdiction. No, it just happens. So Jack Dorsey loves this thing. Satoshi, the mental model I would like you to employ today is a very simple one. Obviously, I painted the picture of a protocol, so that's a great one to have. The second one, digital country. Wow, I can own that currency. The third one, and this is a really interesting one. Think of it as digital gold, and that's what Satoshi's asking us to do here. He's saying, you know, what if we had something that was as scarce as gold? Who cares? Who cares about industrial value? But it can act as money. You know, what would that be worth? And that's what Bitcoin is. And then finally, Ledgerman has his own comments on Bitcoin, and that's me. This is the internet's money. Let's go to the next. Oh, sorry. And finally, before I pass it off to Brian, you know, I've had a lot of fun investing in my career. And what I did intuitively is I saw all these protocol layers being built, and they were built on an open source way. And I was always amazed at how and why developers would develop all these great things that companies and applications used afterwards. And but all of that application layer captured all the value. That's Facebook, Apple, Amazon, Netflix, Google. All of those are taking advantage of the protocol layers that were open source and built for the internet. Now, we're in a really unique situation here because this protocol, you can actually buy it. In order to use the protocol, big B Bitcoin, you have to buy a little b Bitcoin to use it, to transfer value from A to B without a third party. You have to buy a little b Bitcoin. There's only 21 million of them. And there's 25 million millionaires. So every millionaire can't even buy one whole Bitcoin if you really kind of think it through. So my point here is this is an opportunity now to buy the protocol. So it would be like me standing in front of you in 1992 and saying, hey guys, this email thing is going to be huge. I really think it is. Trust me. And at this point in 1992, you probably had your mother, two friends that were using email. And you're like, yeah, right. Who's going to send email? Happy birthday. What am I going to use it for? That's kind of where Bitcoin is right now. The network is so small relative to where it will be. And can you imagine if I said to you, hey, you can buy a little piece of this SMTP protocol. And you know what, if this thing really takes off, we can earn like a penny an email or whatever it is. So my point is, this is an opportunity to buy the protocol now before the protocol really kicks in and begins to become used. So that's another mental model that you can think about. Let's see, with that, I'm gonna pass it to Brian.
So we're running about 15 minutes behind, so I'm going to go ahead and get to the why does Bitcoin have value and why you want to put this in your investment portfolio. So when I graduated from University of Illinois in 1990, this is like pre-commercial internet. Commercial internet started around 92, 93 when Congress changed the laws and allowed commercial transactions and advertisements on the internet. Pre-1992, 93, it was actually against the law to do a commercial transaction or advertise on the internet. And so my University of Illinois buddies, I went to be a stockbroker with a company called A.G. Edwards & Sons. They were still doing their computer science stuff. And they started buying up domain names back in the early 90s. And I thought they were crazy. I was like, why are you buying these internet domain names like Coca-Cola.com or Disney.com? And they're like, oh, there's only a couple million people using the internet today. And when there's billions of people using the internet, these domain names will have value. And that's what Bitcoin is today. Bitcoin is like a domain name. There's a finite supply of Bitcoin, just like there's a finite supply of domain names. The way you value Bitcoin is how you value domain names. The reason domain names were $25 a domain name back in the early 90s is because there were very few people using the internet back then, okay? The reason Bitcoin's at $12,000 today is because there's only 100 to 200 million people using Bitcoin today. In 10 years, when there's billions of people using Bitcoin, Bitcoin's value is going to be up. And so that's how you that's how you have to think about Bitcoin. It's valued on a network effect. We don't use PE ratios or price to cash flow or other types of traditional valuation methods. We use what's called network effect and network valuations to value Bitcoin. So that's just kind of the how you have to think about it. You have to think differently about Bitcoin. You have to, it's valued in a different way than we value traditional assets. I might skip through a couple of these just in interest of time. So most of us are familiar with PayPal. PayPal owns a blockchain application called Venmo. Okay, PayPal's DNA is Bitcoin. When Elon Musk, Peter Thiel, and Luke Nosek started PayPal back in 1998, their whole goal was to create something like Bitcoin. They wanted to create their own currency that was independent of governments and central banks. They failed. They couldn't solve what Tim was talking about, the double spend problem and the Byzantine general issue. It was that computer science problem they couldn't figure out. These are very smart people. They couldn't figure it out in 1998. Mark Andreessen, I went to University of Illinois with Mark. He started a company called Netscape after college. He runs A16Z today. He knew when he started Netscape that they were missing something. They were missing that ability to transfer value through the internet. And they couldn't figure it out either. And in 2009, when Bitcoin was invented with Satoshi Nakamoto, it solved these problems. And all Bitcoin is, it's software. It's open source internet software. It solves that double spend problem. And the way it solves it, it's a ledger that's distributed around the world that enables peer-to-peer transfer of value through the internet. And so that's the problem that was solved. And so going back to why Bitcoin has value, we use our basic economics 101 classes that we learned. There's a finite supply of Bitcoin. The amount of Bitcoin that gets generated gets cut in half about every 4 years. So about the first 4 years that Bitcoin was around, there was 50 Bitcoin being generated every 10 minutes. That's that first dot right here. And then over the next 4 years, it was 25 Bitcoin every 10 minutes, and then 12 and a half Bitcoin every 10 minutes. And then in May of 2020, there was a halving again, and currently there's 6.5 Bitcoin, or 6.25 Bitcoin being generated every 10 minutes. So there's 900 Bitcoin being generated every day today, okay? The maximum amount's gonna be 21 million. So there's about 18 million Bitcoin that's been generated today. So it'd take 120 years to create the next 3 million Bitcoin, because it's half and half and half about every 4 years. So we know the supply. The supply is fixed, it can never be changed, and then to determine the value, you have to look at the demand. So if we look at demand between 2012 and today, the number of Bitcoin wallet addresses has been growing at 311% per year. So demand's going up, okay? So if demand's going up and you have a finite supply of something, then the only thing that could change is the price. And that's why Bitcoin goes up in value. That's why it's the best performing asset class 9 out of the past 11 years. Bitcoin goes through cycles too. There are certain times you want to own Bitcoin and certain times you don't want to own Bitcoin. The best time to own Bitcoin is after one of those halvings. So a Bitcoin halving, like I said a while ago, is that's when Bitcoin supply gets cut in half, okay? So if you have half the amount of the daily supply of Bitcoin and you have the same amount of demand or increased demand, the price is going to go up. So these purple areas right here, this is the 12 to 18 months after a Bitcoin halving. And these are the best times to be invested in Bitcoin. And so the most recent halving was in May of this year, and we're back into this sweet spot again of now's a good time to own Bitcoin. When we look at who else owns Bitcoin out there, we use what's called S-curve analysis. And what S-curve analysis says is that the amount of time it takes for a new technology to go from 0% adoption to 10% adoption is the same amount of time it takes to go from 10 to 90%. So going back, I'm gonna use the computers like PCs as an example. Apple invented the personal computer in 1977. By 1980, about 0.1% of households own a personal computer. So we'll use 1980 as the starting point of the PC revolution. When I graduated from college in 1990, my parents gave me an IBM PS2 computer for my graduation present, okay? I was one of the 10% of people in America that had a personal computer in 1990. But then by year 2000, 90% of households had a personal computer, okay? So it took 10 years from 1980 to 1990 to go from 0% adoption to 10% adoption. And then it took 10 more years to go from 10% to 90%, okay? So if you invested in that 10 to 90% area, you invested in Microsoft, Intel, Dell in the 1990s, you made a lot of money, okay? So you could use what's called S-curve analysis to determine when it's a good time to invest in a new technology. Well, in 2019, last year, 10% of US households owned Bitcoin last year. Today it's 15%. We're on the way to 90% of US households owning Bitcoin over the next 9 years. By 2030, 2029, 2030, 90% of households will have some sort of Bitcoin wallet address or some sort of blockchain address so that we could transfer value. Just like we could transfer information today via email, we're able to transfer value peer-to-peer in about 10 years with everyone. If we look at how Bitcoin, the people who are investing in Bitcoin today, it skews towards the younger generations. So if Schwab put out this data about 6 months ago, and it broke out the 10 largest holdings by age group. So if you look at the millennials, the 5th largest holding for people under 35 at Schwab is the Grayscale Bitcoin Trust. Okay. If you look at Robinhood, which skews millennial too, 2.5% of Robinhood's assets under management is in Bitcoin and Ethereum. So the younger generation, this is their preferred asset class, okay? Over the next 25 years, there's gonna be $68 trillion of wealth that's gonna be transferred from the older generations down to the younger generations. And this is a tailwind for cryptocurrency and investments like Bitcoin. A certain portion of the $68 trillion will be invested in Bitcoin and Ethereum and other cryptocurrencies over the next 25 years. The Federal Reserve Bank in St. Louis is the hub of research for cryptocurrency. The Federal Reserve Bank in St. Louis came out with a white paper in January 2018, and it said in their white paper that Bitcoin will emerge as its own asset class and thus have the potential to develop an interesting investment and diversification instrument. And that's what Bitcoin's being used for today. It's being used as a diversification tool for investment portfolios. And the reason people use it as a diversification tool is because it has a very low correlation to traditional asset classes, like the stock market, bond market, gold, and real estate. And I mentioned this a while ago, if we look at Bitcoin as an asset class and we compare it to other asset classes like REITs, high yield bonds, cash, emerging markets, large cap stocks, Bitcoin's been the best performing asset class 9 out of the past 11 years. And when it's the best performing asset class, it's not just the best performing by like 2%. You know, for example, this year, Bitcoin's up, and this is data through July 31st, Bitcoin's up 57% this year. The next best performing asset class are high yield bonds. They're up 5.8%. So if you look under the year 2020, you see 10x. Bitcoin this year is 10 times better than the next performing asset class. If you look at 2019, Bitcoin was 3 times better than large cap stocks. If you look at 2017, it was 33 times better than emerging markets, which was the next best performing asset class. So when Bitcoin does well, it does well exponentially. The other thing I want to point out with this is if you look at the red blocks there, it says Coinbase effect and PayPal effect. The reason Bitcoin went up 5,866% in 2013 was because Coinbase came online. Pre-Coinbase, you had to go to Japan at Mt. Gox to buy your Bitcoin, or you had to go to like a Bitcoin meetup where you give someone cash and then they transfer Bitcoin to your phone, okay? When Coinbase launched in 2013, it made it easier for people to buy Bitcoin. And when you make it easier for people to buy Bitcoin, the price goes up. It went up 5,000% in 2013. News leaked out about a month ago that PayPal is getting ready to open up to Bitcoin. There's 325 million PayPal accounts. There's 50 million Venmo accounts, which PayPal owns. So there's gonna be 375 million accounts at PayPal and Venmo that will be able to buy Bitcoin. There's 35 million Coinbase accounts today. So there's gonna be 10 times more access to Bitcoin when PayPal opens their doors. Yeah, so using Bitcoin as a currency, that use case failed 5 years ago. So Bitcoin's not used as currency because the block size is too small and people don't want to spend their Bitcoin because they think it's gonna be more valuable in the future.
Yeah, so FinCEN, which is a part of the US Department of Treasury, they define money as a unit of account, a store of value, or a medium of exchange. It doesn't have to meet all three. So that's 3 different ways in which money can be used today. It doesn't have to do all 3 at the exact same time. So Bitcoin is still money, even if it's not used as a medium of exchange, because it is a unit of account and it is a store of value.
So Perianne went through the history of money a while ago. And so in 1100, the Chinese invented paper money that sat on top of the gold system, okay? The Chinese are inventing their digital yuan today that's going to sit on top of the Bitcoin system, which is the new digital version of gold. So 1,000 years later, they're doing the same thing, that they did 1,000 years ago. There will be a transactional layer sitting on top of Bitcoin. Bitcoin is basically a digital version of gold. We don't spend gold today. We use, currency. So there will be a transactional layer sitting on top of that. That will either be the Chinese digital yuan, Libra, Venmo. I think it's going to be Venmo. It's going to be the application sitting on top of the Bitcoin gold standard, or it could be, the U.S. digital dollar that may come out eventually. If we take a look at how Bitcoin fits into an investment portfolio, basically what this chart shows is that if you had a small amount of Bitcoin, between 2 and 10% of your portfolio, it increases the performance. But what's more important is that it actually decreases the risk in your portfolio. So I just want to run through these numbers real fast. So the typical portfolios, we say it's 60% stocks, 40% bonds, no money in crypto. That return on that portfolio over the last 5 years was 7.74%. The volatility was around 8%. The Sharpe ratio was 67%. And the maximum this portfolio went down was 21.64%, okay? If you would take 2% of your portfolio and add it to Bitcoin, so you have 58% in stocks, 40% in bonds, 2% in Bitcoin, your returns went from 7.7% to 10%. Your volatility just barely changed, but look at the maximum downside. Bitcoin actually protected your portfolio on the downside. When the markets were going down, Bitcoin protected it. So if you look at what's called the Sharpe ratio measures risk-adjusted returns in a portfolio. The Sharpe ratio goes up when you add Bitcoin to your portfolio. If you look at the bottom line where you put 10% of your money in cryptocurrencies, your returns go from 7% a year to 20% a year, and your Sharpe ratio goes from 67% to 151%. That means you're getting paid more in return for the amount of risk that you're taking. What I'm going to go through next are our 4 valuation models that we use to determine the future price of Bitcoin. This one is very simplistic. It's a linear regression line on a logarithmic scale where half of the value of Bitcoin is above the dotted line and half of the value of Bitcoin is below the dotted line. And basically what this says is that Bitcoin at the end of this year, the fair price should be 37,000. The price next year, at the end of next year, 95,000, then 240, and then 607. Sometimes Bitcoin is 90% above that trend line. Sometimes it's 90% below that trend line. Today it's actually below, but there's an 87% correlation between this model and the price of Bitcoin. We use this to determine just the direction. A more sophisticated model is based off what's called Metcalfe's law. So Robert Metcalfe came out with a way to value networks. And the way you value a network is you square the number of users. So what we do is we square the number of users of Bitcoin, we multiply that times the transactional value, the amount of money flowing through the Bitcoin network, and we come out with a formula. So between 2014 and 2017, the price of Bitcoin and this formula were 94% correlated. And then what happened in December of 2017 was the ability to short Bitcoin. So when you short something, you're betting against it. You're betting it to go down. So my thesis is that this model is still accurate. This model shows that the price of Bitcoin should be worth $42,000 today if it wasn't for the shorts that are out there, people betting against it. Once Bitcoin breaks above the previous all-time high of $20,000, the shorts will be forced to cover because they have unlimited risk on the upside. So they'll be forced to buy back their Bitcoin that they're betting against. When that happens, we'll see Bitcoin go from $20,000 probably to $100,000 in a very short time period, just like Tesla stock did recently. Tesla stock traded between $200 and $400 for about 5 years because of a big short position out there. When the shorts covered and the institutions moved in, Tesla went from $400 to over $2,000. Okay, same thing's what happened with Bitcoin once the shorts start covering. Another model we use is based off scarcity. It's called stock to flow model. Today, gold is the scarcest asset on earth. Bitcoin is the second scarcest asset on earth. After the next Bitcoin halving in 2024, Bitcoin becomes the scarcest asset on earth. Gold has a market cap of $12 trillion today. Bitcoin's market cap is 200 billion. Gold is 60 times larger than Bitcoin today. But in 4 more years, Bitcoin will be scarcer than gold. So you would think that Bitcoin's value should be equal to gold's value. And that's what this chart measures. It measures the scarcity based on what's called a stock to flow model. What this model says is that a year after the May halving, which was a few months ago, that Bitcoin should be $100,000. A year after the halving after that in 2024, $1 million. And in 2028, a year after that halving, Bitcoin should be $10 million of Bitcoin. And I know I sound crazy when I say that, but the question is, I believe Bitcoin will be $10 million of Bitcoin in 10 years or in 2028. The big question is, what does $10 million buy you in 10 years? That's the question you have to ask yourself. Is a car $1 million? Is an average house $10 million? That's what you have to ask yourself. Because we're printing so much money, we don't know what our money is going to be worth in 10 years. The last model we use to value Bitcoin, we take dollars out of it altogether, and we just compare Bitcoin to gold. Okay? What this model shows is in 2012, it took 1/10 of an ounce of gold to buy 1 Bitcoin. Today, it takes about 6 ounces of gold to buy 1 Bitcoin. And in about a year, this model says with 99% accuracy that it's going to take around 80 ounces of gold to buy 1 Bitcoin. Okay, an ounce of gold is about $2,000 today, so that comes up to about $160,000 in about a year. So we have 4 models that tell us today that Bitcoin should be worth $100,000 by the end of next year. So a lot of people say, well, why don't we just buy and sell Bitcoin and trade it and be short-term investors? Well, if you do that, you're going to miss out on the opportunity. So over the last 10 years, Bitcoin's averaged 251% a year in return. If you miss the 10 best days per year, your return is a negative 25% a year. So all the return plus some comes 10 days a year in Bitcoin. So it's just kind of sitting there not doing anything for 355 days a year. And then for 10 days, it does something, okay? And so this is what this chart shows. So if you invested in Bitcoin 10 years ago and you had $100,000, it grew to 100,000. If you missed the one best day over the past 10 years, you only made $64,000. If you missed the 7 best days over the past 10 years, you only made half the amount. And if you missed the best 60 days over the last 10 years, you only made $7,000 instead of $100,000. So Bitcoin is meant to be owned for the long term. You don't trade it, you don't outthink it, you buy it and you hold it for the next 10 years, and then in 10 years you take a look and see what it's worth. So just to review why invest in these types of assets: it increases your Sharpe ratio. Based on the S-curve, it's the next mega trend, just like computers were in the 1990s and mobile and smartphones were over the past 15 years. Increases your portfolio performance. It's a completely misunderstood asset class, which creates an investment opportunity all to itself. And then it's protection against economic uncertainty. So what Perianne was talking about earlier, if the world economy does have too much debt and it blows up, Bitcoin is one of the exhaust valves that can protect your portfolio. So here's the 60-second pitch on what I do. I'm the CIO of Off the Chain Capital. We're one of very few investment funds that have outperformed Bitcoin since 2016 when the fund's founded. We do it in a value way. What I found out is that basically the best way to outperform Bitcoin is to find distressed sellers or people that pay more than Bitcoin what they should. And so that's what we do at Off the Chain. we look for mispriced digital assets. We buy Bitcoin from bankruptcy claims. We buy Bitcoin from electric utilities who have regulators who force them to sell Bitcoin at a future price or a fixed price in the future. And that allows us to outperform Bitcoin. We're long only, we don't use leverage, and we have a very long holding period. If you look at our portfolio versus the S&P 500, we have a 0.00 R squared. What that means is that our fund has zero correlation to the stock market. So it's not negatively correlated. If the stock market goes up, we don't go down, or if the stock market goes up, we go up. We have no correlation at all. Sometimes we go up when the stock market goes down, sometimes we go down when the stock market goes down. There's no correlation. Like I said, we're the #1 performing blockchain fund over the past 3 years in the HFRI universe. And one of the things I'm most proud of with the fund is that when we built the portfolio, this is a family investment fund that was started in 2016 by my son Luke over there. He started the fund when he was 16 years old. I took it over about 1.5 years ago, and I institutionalized the fund for endowments and foundations. Okay, and what that meant is, or what that means is that I wanted to provide exposure to Bitcoin with downside protection. And so that's how the portfolio is set up. If you look at the average up quarter in Bitcoin, Bitcoin goes up an average of 16% in the up months or up quarters. Off the chain goes up 21% in the up quarters. In the down quarters, Bitcoin goes down an average of 8%, and our portfolio still goes up. And the reason is that we're value investors. We found ways to buy Bitcoin for 50 cents on the dollar. And so if we're buying Bitcoin for half as much that it's worth, then our portfolio still goes up when Bitcoin's going down. The fund's averaged 119% a year since inception versus the S&P at 13% and Bitcoin 99%. And then I'm gonna turn it over to Tim. Tim is a consultant for like helping people find other ways to invest in Bitcoin. So I'll let him run through a few other ways to invest in Bitcoin, and then we'll open it up for more Q&A.
An easy way to get exposure to Bitcoin, just to buy between 50 and a few $100, is just to go on to Square's Cash App, and it's right on your phone. And that's Jack Dorsey's fund. They're going to ask you to ACH, and it's safe, and you can buy a little bit of Bitcoin through Square's Cash App. If you're looking to make a bigger commitment, River Financial, I'm an advisor for River Financial. They're Bitcoin only, and they're a really easy way to just onboard. You can call someone. I find that the other exchanges are really hard to deal with. And River will take your call and step you through the onboarding process. Very reputable company and long-term Bitcoiners. Gemini is another great, that's Tyler and Cameron Winklevoss. They started an exchange, they call it Gemini. And that's a good place to, set up an account on Gemini and buy Bitcoin there. You've all heard about Coinbase. If you're in your IRA, it's hard to buy Bitcoin unless you set up your own LLC and have a special purpose vehicle to buy Bitcoin. Most of us will just want to call our broker and buy Bitcoin through GBTC. It's the only ETF available. Unfortunately, the premium, it really swings quite a bit. It goes between 5 and I've seen it as high as 100%. Currently it's 20%. It usually goes between one of my clients buys GBTC when it goes to a single digit premium. And so it was single digit premium 2 weeks ago. Now it's back to 21%. So, and they charge 2% a year to hold your Bitcoin. So it's an inefficient way, but it is one nonetheless. Many use it to invest their IRA money. Bitwise has an index fund. So the founder of ETFs joined Bitwise, and they're trying to start an ETF for Bitcoin. By the way, adoption, guys. This is one of the first times where retail investors have so big an advantage, a head start versus the institutional investor. The ETFs are coming. Right now, we just have GBTC. This ETF guy from Bitwise, he'll get it through. Now, I don't know if it's in the next 12 months or 18 months, but when he does, that's adoption. That's more use of the protocol. So let's get in front of that. Brian talked about uses of Bitcoin for institutional investors. Some of my clients are institutions. All they want to talk about is Sharpe ratios and stuff like that. I really don't care about that. What I do want you guys to know is the institutions are going to start to buy Bitcoin. They haven't been able to buy it in the past because they don't have any place to put it. They can't custody it. But now Fidelity is offering a way to custody their Bitcoin. So we're here today, 18 months ahead of when the institutions are going to finally use this protocol as a store of value. And finally, off the chain. Brian runs a really interesting fund. He's a value guy, finding really unique ways to purchase Bitcoin at a discount to you just going out and buying Bitcoin yourself.
So Bitcoin isn't controlled by any company or any country. So we went through this back in the 90s. So there were companies called Prodigy and AOL, and that allowed you to get online before you can get on the internet. Those companies failed because they were centralized, and the open internet won. So I look at Ripple as the same way. Ripple is controlled by a company. Because it's centralized within a corporation, I don't think it will do as well as an open source protocol like Bitcoin will. So Jeb McCaleb, who was the founder of Mt. Gox, he actually hard forked the XRP token into what's called Stellar Lumens. Stellar Lumens is the open source version of Ripple or XRP. So that might be a better option than Ripple or XRP.
Yeah, and Ripple, they what they promote XRP to be used for is for interbank settlements. That's a very different use case than a store of value or a medium of exchange. The way in which they're promoting the use of the protocol and what they're doing with that technology is mostly for remittance. And they're currently doing a lot of remittance between the United States and Mexico. So it'll serve somewhat of a different purpose.
I wanted to mention one other thing. Read the white paper. And there's one other thing that you need to read. It's an unbelievable summary of today's presentation, and that is like the Bitcoin standard is just unbelievable. And
so it's funny that you bring that up. So we brought copies of the Bitcoin standard book. So my wife is table 11 back there. So feel free to pick up a free copy of the Bitcoin standard book as you leave. Thank you for taking the time to join us.